How is everybody doing? Welcome back to another episode of The Banker Next Door. I am your host, Dr. Joe Berquist. Today, I thought we would do something really fun. I have 6 articles that basically came out that looked at 6 different topics for 2025. It was kind of called like the Big Picture series from S&P Global. So we're going to go through in just a minute and take a look at those. I hope everybody's having a great week as we're coming up on Thanksgiving tomorrow. I just wanted to drop a quick line. If anybody did not see my interview with Jason Lang from Chatham Financial on Monday, please check that out. And then yesterday I did the episode, How Much is Your Bank Worth? So if you didn't get a chance, check out those 2 episodes when you get a second. There will not be a BND strategy room this weekend. I am working on a special episode though that I'm hoping to premiere this weekend. So check that out. And then just a note, I am taking a week off for Thanksgiving week next week, so I won't have any new episodes next week, but I will be back with all new episodes the week after. I'm just taking a little holiday break from it's been a long year of banging out a lot of episodes so far. So with that said, let's get into okay. So what are basically, I'm not gonna like run through every one of these articles because we'll be here for 2 hours. So, but I'm gonna give you the overview of each one of these. But let me just run through what are the 6 topics that we're basically going to look at here today. So the first one here is M&A. So we're going to look at what is the outlook for bank M&A for 2025, bright spots, shadows on deal-making horizon. We're going to look at capital markets, issuance rebound hinges on rate cuts. We're going to look at supply chain outlook, dealing with consequences. We're going to look at commercial real estate outlook, weathering the storm. We're going to look at generative AI outlook, from hype to value, maybe not. And finally, we're gonna look at commodities, commodity outlooks, power, metals, policy shaping AI's growth. So those are basically the 6 categories, if you will, that we're going to take a look at here today. So let's look at what is the take here on M&A outlook. So the rate cutting cycle that started in 2024 should pave the way for greater M&A activity. Lower interest rates and higher stock valuations will help bridge the gap between buyers' bids and sellers' expectations. If you saw any of the episode from yesterday, there's a little bit more in depth on that. So check that out if you're interested. The reduced cost of acquisition financing will entice more deals from private equity. The proliferation of alternative asset managers helped push M&A to new heights in 2021. While it will take time for deal volumes to once again reach record highs, a return to historical norms in and itself would represent an uptick in deal making. Clarity around political leadership could also increase executive confidence to pursue acquisitions. 2 sectors where this is especially true are technology and oil and gas. Those industries, along with private equity, have the potential to play significant roles in the deal-making recovery. And then it just goes on to say, private equity at the ready, oil and gas on consolidation course, tech challenges to an M&A recovery. And then this is kind of interesting. So it says, when oil and gas experienced an M&A boom, the technology space dealt with a deal drought. The spigot opened a bit in 2024 as spending on tech targets surpassed 2023's full year total in just 3 quarters. But the rebound remains limited, with tech M&A spending still subdued. So again, kind of interesting there. So again, we're looking at potentially a little bit of a bounce back in the M&A market next year. Let's see here. What's the take on let's see here. What do we got here? Capital markets. What's the tape on capital markets? So corporate debt issuance bounced back strongly in 2024 as investors look to lock in prevailing rates at or near the top of the cycle. Equity issuance recovered more gradually as higher for longer rates and the electoral uncertainty worldwide led to some offerings being pushed back to 2025. Stronger macro fundamentals and central bank rate cuts could help to unlock pent-up IPO pipelines and boost capital markets activity next year. I would agree, but I think there's some choppy waters there too. And then it goes on to say debt issuance surges on healthy investor demand. Stocks rise as IPO activity stumbles. Fed embarks on long-awaited cuts, and then what's on the horizon. So despite stocks surging to record highs through much of the first 3 quarters of 2024, global equity issuance and IPO activity has begun to lag last year's pace, a sign of a potential slowdown into 2025. Yet investor sentiment improved markedly following the U.S. presidential election, with risk appetite and expectations for higher equity market returns reaching their highest levels in 3 years. So yeah, I think so. I again, IPO market, I think, is a little questionable. Corporate debt issuance. I think a lot of that is going to depend this year on interest rates and how much it's going to cost companies to roll their debt. I've talked a lot in different episodes over during this year about the cost of rolling debt and why companies have to roll debt. If you haven't seen my Lord of Easy Money series, definitely go check that out when you get a minute. There's a lot of info around that whole topic. But yeah, like I said, I mostly I'm thinking positive, but I think there could be a little, waters could be a little choppy on that this year. We'll see what happens here. Okay, supply chain. What's the take on supply chain? If 2024 was the year of elections, 2025 stands to be the year of policy implementation. Protectionism looks set to remain on the agenda in the U.S. and EU, while China's reaction to those measures may become more active. China is joining the EU in widening its carbon emissions compliance markets in 2025, providing economic incentives to tackle climate change. Sorry, I didn't mean to laugh out loud at that one. Companies can manage geographic risk from policy and climate change by diversifying origins in the long term, spending on technology to build agility in the midterm, and sourcing goods or services from multiple suppliers instead of one, also known as multi-sourcing in the short term. Spending on automation can be easily wasted, particularly in AI. Logistics investments will prove controversial in 2025 in the U.S. ports sector. Watch out for a new strike, and additive manufacturing could change the shape of economic development. And then it goes on to say, the price tag for protectionism, counting the cost of climate change, investing in diversification, and then making the most of the rise of robots. So interesting comments there. I like that comment at the end there. Spending on automation can be easily wasted, particularly in AI. We're going to take a look at AI here in a second, but logistics investments will prove controversial in 2025 in the U.S. port sector. Watch out for a new strike. I think that's some really interesting comments there. Not perhaps some of the mainline comments you've heard more recently, right? So I think supply chains definitely, worth keeping an eye on as we go in there, as we go into the new administration, and what could happen with tariffs and other things that come down. But we'll see there. I remain cautiously optimistic. All right, so what's the next one here? Commercial real estate, weathering the storm. I've talked a lot about commercial real estate here in a number of episodes, but let's see what they hear. The take: changes in post-pandemic behavior have weighed on the cash flows of many commercial properties as companies have shifted to hybrid work models. Higher interest rates have left borrowers in the CRA market with significantly heavier debt service on their loans, and many borrowers seeking to refinance might find credit less available, leading to defaults, particularly in the beleaguered office segment. Still, not all commercial real estate borrowers face the same fate. Lenders have steadily built reserves against the asset class over the past year. Stress likely will be specific to certain locales and asset types, and working through the challenges could take longer than many think. That said, any pain should not be great enough to spur deleveraging in the financial system and threaten the U.S. economy. Office properties remain the top worry. Regulators, investors still targeting banks with high CRE exposure. Life insurers post record mortgage loan exposure amid rising asset quality concerns. And then looking ahead, the CRA market remains under stress, but it seems likely that losses from CRE loans will surface over the next few years rather than all at once, as some have feared. I think there's a lot here. Obviously, interest rates are going to play a huge role in this. If the Fed continues to, the Fed's brought rates down 75 basis points, but that has really been offset by the increasing 10-year Treasury. So, we'll have to see what happens here. If the Fed continues to bring those rates down, if they come down another 100 to 200 basis points, that will certainly help. You're still not going to get, I think people have to understand, like, you're not going to get back to that 3.5%, 4% range that a lot of these deals were financed at, 5, 6 years ago. You're not going to get back to that range. I think at best, maybe you get back to 5%, maybe you get back, 4.75, 5%, 5.25, somewhere in that range. That will absolutely help, but it's not going to be a cure-all. And I think one of the big problems you have is what's called the maturity wall that is about to hit. That's going to hit 25, 26, and it's not going to hit its peak until 27. So you've got a lot of real estate maturing over the next 3 years, and you also have a lot of corporate debt that's got to be rolled in the next 3 years. You have a lot of treasury debt. Treasury bonds that got to be rolled in the next couple of years. So there's a lot of debt out there that needs to be rolled. Interest rates are going to play a key factor in this. And, like I said, I do agree with, I think the stress will be specific to certain locales and asset types. I don't disagree with that. But we'll see. Yeah, we'll have to see how this plays out. I mean, if interest rates kind of end up staying where they're at, or for some reason, if inflation ticks back up again and the Fed decides to pause on the rate cuts, we could be in for a little bit rockier weather there on that one. So, okay. Generative AI. Let's take a look at the AI thing here. So while there is a debate to be had about the relative transformative power of generative AI, the software has sparked an adoption and spending frenzy. The focus that generative AI has placed on various aspects of technology infrastructure has changed priorities and redirected cash flows. Fleets of new ventures have been launched on the waves of investment in this relatively new sphere. The larger question is how benefits will be delivered and who can make the most of them. A rethinking is underway as organizations move from mere fascination to requiring real delivered value from generative AI. And then it goes on to say, from LMNs to modular AI systems, infrastructure takes on new significance. Shift to general AI still dominating capital markets. And what does it say here? So deals revolving around generative AI technology are on the rise. According to 451 Research's M&A knowledge base, 1/4 of all technology M&A value in 2024 as of September involved a target with machine learning capabilities. This proportion continues to climb as end user expectations for AI capabilities grow, up from 1/5 of the deal value in 2023 and a little more than 10% of deals in 2022. So here's the thing with AI, and I think you're going to start to see this play out next year. My take, you have a lot of companies, like OpenAI. I did an episode on them trying to, they want to try convert to like a for-profit company now. They're trying to make money. You got what's the other one? It's Anthropology. It's not the retail store. I thought it was called like Anthropology. I forget the other one of the big AI companies. Amazon just invested $4 billion in them the other day. But the thing with AI is that now you have all this spending, but they're still not making any money. And I think the real benefit right now and the benefit in the next 5 years with AI is going to be in efficiencies, being able to kind of augment how people do their jobs, what they do with it. The question that remains is the revenue stream. What new revenue streams can AI actually generate for you? And right now, not really doing much of anything. And that is the key ultimately to their profitability. If they can't make the business case that AI is able to actually generate or create new revenue streams, a lot of this hype is going to fizzle. And it's, again, I don't think AI is going anywhere. AI is going to continue to develop and get better in the coming years. And I think it's going to change things in ways that perhaps we haven't even seen yet. But like I said, the fact remains, I think the real benefit to it at the moment is in efficiency, not so much in generating revenue. And that's where this whole thing is all going to go in 2025. Can it begin to generate new streams of revenue with AI? That's going to be the big question there. So, okay. Last one, commodities. What's our take here? The rise of artificial intelligence emphasizes the need for augmented infrastructure in the U.S. to support intensifying workloads. The technology requires building additional data centers, gargantuan amounts of new power capacity, and support from federal and local lawmakers, and it needs it all now. Those power demands potentially conflict with broad decarbonization plans. The aging U.S. transmission and distribution system is one of the primary bottlenecks to incorporating the much needed proposed renewable energy generation, essentially lying dormant in interconnection queues. So, big tech has turned its sights to the U.S. nuclear fleet, among other things, even going so far as to resurrect the 3 Mile Island nuclear plant in Pennsylvania, the site of a partial meltdown in 1979. I did an episode on that. Meanwhile, the outlook of data center deployment remains extremely bullish. Data center owners and energy stakeholders who are contemplating fast steepening load projections publicly remain committed to their long-term green energy objectives with a propitious legislative calendar in 2025. Lawmakers are expected to delve into these matters. In this context, the critical minerals supporting the entire ecosystem are high on investor radars. So you got the whole data center build out, you got the building, the powering, the build out, and the critical minerals underpinning it all, the policy perspective. So I think in a nutshell, I think that you're going to end up at kind of a big fight here over the whole data center thing. And I think we're going to see how this whole thing plays out. And I'll have more on that soon. But anyway, well, that's the 6 topics there. That's what we got for the big turnout for 2025. I hope everybody enjoyed this episode. I would really like to just wish everybody a great Thanksgiving. Have safe travels out there as you travel around. And I wish everybody a best time over this holiday break. And I will be back to see everybody again real soon. Please make sure to like, share, and subscribe. Check out some of the other content on the channel. And like I said, have a great time out there. Happy holidays. I'll see everybody again real soon. Thanks.